Now, why is it a growth stock? Because it has a 51% quarterly revenue boost. It just shows how fast the company is growing. In this video, we're going to go through some stocks with huge potential in 2021 for you to either watch or buy. Just a quick disclaimer before I start, I am not a financial advisor. This is not financial advice, and you should seek financial advice for your individual circumstances. Now, what is growth investing before we begin? Growth investing is a type of investment strategy where you invest in companies where the earning potential is going to exponentially grow, or so you think. It is different to value investing, and value investing is where you invest in companies that are trading at a significant discount and you think the real value of the company is significantly higher. For example, they have underlying assets in their balance sheet which is not accounted for in their stock price. If you're new to the channel, my name is Jack. I post all kind of videos on stock market and investing. If you're into that kind of content, then make sure you hit that subscribe button, and while you're there, make sure you hit that like button because it does really help out the channel and motivates me to make more videos for you. With that being said, let's get straight into the video. The first stock in my list is a company called Palantir. This company helps governments and other organizations actually analyze data and make better decisions. One of the actual platforms they've developed is called the Palantir Gotham. It does sound like something out of a Batman show, and it was actually used in a superhero-like scenario. In 2018, a hurricane struck the US state of Carolina, and this platform was used to analyze flood data and weather information to find out which areas were most in need of help, and supplies were actually sent to those areas first. So from this, you can actually see how powerful the platforms are. Now, Palantir's stock price has been increasing quite rapidly, especially in the last couple of months. It's currently trading at $35 a share. If we look at the stock chart, we can see that from November to now, it has increased around 230%, going from $10 a share to around $35 now. If we look into the financials, we can see that 12 months revenue is around just under $1 billion, but the company is not yet profitable. Now, why is it a growth stock? Because it has a 51% quarterly revenue boost. It just shows how fast the company is growing. Now, why do I think the company is growing quite rapidly? Because they have a huge amount of government contracts backing them. They recently, for example, got a contract with the UK National Health Service for around £23 million. And it has a few big partnerships with the likes of IBM and also US government organizations. The way I see it is like Palantir is becoming the default data platform provider for government organizations around the world. The actual industry is growing quite rapidly as well in the long term, which is why I think it will perform quite well in the long run. The next company in my growth list is NIO. For those that don't know, this is an electric vehicle and battery company which is actually headquartered in China but is traded on the US stock exchange. The company just has around 4 different car models at the moment, with plans for around 4 more to come. NIO currently trades at $61 a share, which brings the market cap to around 100 billion. Now guys, the share price of NIO has gone absolutely crazy. It was trading around $21 last October, and now it's trading at around $61, so it is around 181% increase. Guys, what you need to remember is that in China in 2020, there was around 1 billion EV vehicles sold, so electric vehicles. But this number is probably going to grow quite rapidly because the EV market as a whole is increasing. It is a well-known assumption, at least, that the EV market would actually dominate transportation in the future as more and more governments are putting regulation to support this. Just like Tesla's Battery Day, NIO has NIO Day presentation, which it showcases new technology and new cars it's been working on. In the most recent one, they announced a luxury ET7 EV car. So guys, we know that Tesla is currently dominating the EV market, but one thing to remember is that NIO is a Chinese company after all. It's probable that China wants to boost its domestic companies more than international ones. So China itself is a huge market for NIO. If it can become a market leader in just China alone, then there is a huge possibility of long-term success for the company. So for me, it's a long-term investment. And personally, I'm not too concerned on short-term dips in the stock price, which will inevitably happen. I'm focused on the long-term growth of the company. Guys, one thing to think about NIO is that in China, there is a lot of high-rise buildings, with not a lot of people having the space to park and then charge vehicles. Now, NIO has battery swapping technology. Users can potentially just go to a swapping station and literally just swap out their battery for a charged one instead of actually waiting for them to get charged. I think this will probably be the most important factor to consider when NIO rolls out completely in China. So that's why it's definitely a stock to watch out for in the long run. Before I move on to the next stock, a quick reminder to smash that like button because it does really help out the channel, and hopefully you're enjoying this video so far. The next stock on my list, guys, is Tattooed Chef. Now, this is a weird name for a company. I must say, it's absolutely weird. But it's actually a food company which wants to be a market leader in providing tastier plant-based food options made from sustainable ingredients. Guys, we know that the plant food industry is growing at exponential rates. More and more restaurants and takeaways are catering towards the meat-free alternative options. Consumer preferences are changing as more and more people are becoming more mindful of what they eat and where the food actually originates from. So we can see that the industry as a whole is going through a large amount of change, and Tattooed Chef is right in the center of that. Now, Tattooed Chef is currently trading at $24 a share. Guys, this is a relatively new stock which actually saw a rapid increase in September last year, where it went from around $13 to $26 a share. Price then dipped to around $15 in December, but then it rose back to $24 a share. Where is it currently sitting at now? If we look through the financials, we can see that Tattooed Chef has a market cap of around $1.7 billion. Worth mentioning that it has a very low profit margin at the moment, of around 3%. If we look at the revenue growth, it had $135 million coming in the last year. Now, we have seen a huge amount of growth. It had a 65% growth in the last quarter. The company actually plans to increase its revenue further from a few ways. One of the ways is actually the introduction of new products. Currently, it only has 38 products in the market, which makes up its $135 million in revenue. It plans to increase the product range from 38 to 61 in the next year. And in the long term, it wants to have more than 200 products. Guys, this is quite a risky stock in the short term. It's new in the market and it is growing quite rapidly in a relatively new industry. There are some risks associated with this. For example, consumer taste may change, whereby people opt for eating more cheaper options than trying to eat more ethically. I do believe that in the long term this stock will grow, but it's something to think about in the short term.
Guys, one thing you do need to remember is to always do your due diligence before actually investing in any stock. Growth stocks are very risky, they're very volatile, they're not established companies by the nature of the fact that they are growth stocks, right? They have a huge potential, but there is no foundation they have built so far. So it's always worth digging into the company financials and actually seeing whether you believe in the company yourself. Also, these stocks are very volatile. Now, some people might not be suited towards volatile stocks, and I'll explain why. If you're the kind of person that keeps checking their phone and gets very anxious when they hear certain news around the company, I don't think you're ready to even invest in growth stocks yet, because these stocks are very, very volatile. For example, Tattooed Chef has seen a massive swing. Are you ready to take that on? Because you'll probably get that going forward with these type of companies. And you need to bear in mind that these are not established companies yet. They're not Apple, they're not Facebook, they're not Google. So where there can be huge risk, there also can be huge rewards. You just need to factor that into your specific portfolio. Also, guys, I've got a link in the description. If you sign up to Freetrade, which is a trading platform which allows you to buy and sell shares without paying any commission, you'll be getting a free share. When you sign up, it's kind of like a luck of the draw. It's between £3 to £200 you can get, and that's only if you sign up with my link. That will also give me a free share and you a free share, so it's a win-win for both of us. And also, guys, let me know what you actually get, because guys, some of the stocks I got were bangers, but other ones were, yeah, I just sold them straight away. So I'll be really interested to know what you got.
On the flip side to growth stocks, if you want stocks to give you a passive income, then check out my video here on dividend stocks of 2021. Or if you want to know some key tips when actually investing. Aside from that, thank you so much for watching. Make sure you like and subscribe to the channel, and I'll see you in the next video.